Hello all, welcome to the next episode of loan syndication reconciliation. Today we'll discuss about the rollover and how it works into the reconciliations. So first we'll start with the meaning. What is rollover? So rollover is renewal of a loan. Renewal means if existing loan is there and a borrower want a new loan, so he can reach to the lender and request for the more amount of money. It may be for any purpose, maybe the extension of his business or want to invest in some other part or maybe anything. So he can go and take a opportunity as a rollover to get more amount. So you can roll over into the new loan, and the outstanding principal and other component of a loan, old loan, roll over with the without interest or with interest is depend on the agreement. So to understand this rollover, we have designed a one example, real life example. So if you just watch this table, look into this table. So we have designed one. For example, a person is there, a person name is A, for example. He has taken a home loan, for example, of 10 lakh. Okay. So he's taken the loan around 1st Jan 2023, let assume. And after this, what happened? Post this on November 2023, date is 1st, this month, 1st date. So he's taken 20 lakh more loan. He want more 20 lakhs. So in explanation, I write as a combined outstanding loan. So what happened? The outstanding balance. So he has taken the loan. This loan he has taken. I will write down for simplify it. Has taken on the Jan 1st 2023. This loan he has taken as 10 lakh rupees in 1st Jan 2023, and as per the October, means new loan get passed on the November. Actually this 20 lakh he won on the November. So I name is 1st November 2024. Okay. So as per the calculation, whatever the interest he paid and how much interest amount get hit to his principal amount. So as per the calculation, we assume that 9,15,000 is left as per October 2024. So what if he want 20,000 more loan? So 9,15,000 plus 20,000. So the new loan after the post rollover will be the 29,15,000. So here 29,15,000 will come. For example, we have taken the example as a 10 lakh example. We are taking the example of 10% interest rate, and for the 20 lakh loan amount we are taking the example of 0.9. So here we have mentioned the date as well. So 10 lakh start with the 1st January 2023 and 20 lakh loan start with the 2024. The maturity of both loan is 10 year. So the first loan will expire in 32 and second loan will expire in 34. So whatever the EMI he is getting on 10 lakh is 13,215 rupees as per the 10% interest rate. But however, he has taken the 20 lakh more loan, so total loan amount is 29 lakh and 15,000. So it goes to 36,960 approximately. So this is a real life example of we have taken as a loan part. So same will be replicated for the loan syndication as well, because the lender and borrower, when they agree to take loan amount, so it may be in the 10 million for example, but later on the whatever the borrower investment, like he want to invest in infrastructure, he want to invest into the hedge fund or private equity or many other thing, and he get a huge amount of profit from them, and so he want to expand his business or maybe open new franchisee or open new outlet or open new organization or factory, anything. So he shows his all the profitable things to the lender, same lender again, and the lender is agree with his plan, and they will first they agree with the 10 millions, and now they want 10 million more. So borrower lender will agree and give the 10 million more, but the agreement amount, the agreement is same, the all the terms and condition will be same. So he want the borrower want to not go again the same documentation process and all the stuff of legal document and all. This rollover term is something which reduce the borrower and lender limit work, and get a more benefit on releasing this. So how it get benefited and how it get important, so we'll discuss in this. So some specification are also there. So specification are as a new loan with a different contract reference number is initiated. If for example, if 10 lakh loan is old one and 20 lakh loan is new one, so 20 lakh loan new reference number should be initiated. So this is the specification. Second point, the original loan could be split into multiple loans as a result of rollover. So original loan may be split into multiple part, means if they want to if agreement says there between lender and borrower that they have to pay the interest into differential part, or the interest rate will be different. So that's why the original and the old loan should be specified into different category, but the terms and condition will be the same. The third point says that the original loan could be the consolidated along with the other loan as a result of a loan over. So some specification will be different, but some specification will be combined to both together. Okay. So now we'll move to the feature as well. So feature of a rollover detail. So when defining the borrower drawdown product, you have to specify the involving of product can be rollover. So there is some inside in when rollover will be done. So there is some pricing letter as well. So there is some product also there on what which product it should roll over, and something it will be liquidated, maturity date will be consideration. So this should this term should be in the taken consideration. So what are the key contexts as well? So what product or maybe or something that we discuss in this feature. So how it differentiated. So first is financial investment like bond, certificate of deposit. So in this part, in this product type, it will be get rollover. Retirement plan like 40k, or there is some terms are there we have mentioned. If you are regularly working on your loan syndication, you get this familiar with this term. So this is debt financing rollover over the credit facility. So this is a key concept on this part. So benefit of a rollover. So it is a liquidity management, because if borrower needs money in short span of time, and so this product will play this product rollover will play the important role, because in short time he get a money without less documentation and all this. So this play important is also benefit into the tax benefit. There is one kind of retirement rollover, so it is also benefit on this part. Continuously growth, because if short time period, if he get a more amount of money, so there will be no lag on his investment or continuous growth for the lender, because he want to invest in somewhere, so he get a continuous if he get a money, so he can continuously growth, as well as flexibility, because if loan they are getting with the old lender as well, so they can flexible on some points like interest rate, maybe the maturity date, maybe the term of that loan, or some specification, and convenience as well, because it is very easy to get loan without less document, and the rollover get if the new loan get merged with the old loan, and then he has to pay the whole money without less document. So it is like this. So just an example, real world example, a corporate bond rollover. For example, we taken Reliance Industry, the maturity of 1 million bond approaching. So here we have taken the example of bond. So bond also get rollover. So how it rollover? We have taken the example. Instead of paying, Reliance rollover the bond by issuing new bond, updating the interest rate. So bond get matured, but the Reliance want to not get matured, so he roll over with the interest rate. Like for example, Reliance has taken the 1 billion loan, okay, and maturity date, he again Reliance want a loan of 1 billion. So what he did, he roll over the again the same loan, and updated the interest rate as per the market condition, and again he Reliance get a loan of 1 billion again. So instead of finishing the old contract, on the same contract they will roll over the same term and condition. Something will be changed, like here here the mention as a interest rate updated. Okay, so benefit is same, only the ensure the liquidity for ongoing project aligned with the current market condition. So there is some advantage and disadvantage as well. Advantage is delay immediate financial burden, means if borrower wants some urgent money without less span of time, so it immediately get a money. Potential for higher return as well, if in short time borrower get a money, so he can invest in many sector and many investment tools, so he get a benefit for that in the short time of rate. Offer flexibility in planning as well, so on this part also he get a benefit. The disadvantage can interest roll or cost interest or fees. Sometimes when old loan is there and new loan is there, so sometime borrower may get disadvantage, because if they roll over, so the interest what he has paid in past 2 year 3 year, so again he has to pay the interest, because when they roll over, so again the big amount will come, and the borrower pay the interest as a monthly or quarterly, but it less hit to the less to the principal. So where 10 lakh, if he have the loan of 10 lakh, so he pay the interest of 13,000, so 3,000 hit to the directly to the principal. But now if he take more loan on 10,000, like 20,000 or 20 lakh again, so 30 lakh, so the principal amount will be hit on 10 lakh will be less, so it will be more burden for the borrower as well. Risk linked to changing the market conditions, so something will be there. If the market condition change and the interest rate is very high, so it is very difficult to borrower to pay the interest as well. May result to penalize or restriction, if borrower did not pay interest amount on particular date or particular month or quarter, so it may be penalized and restriction as well. So again, moving to the next part is rollover in the financial market. So if we see, if we now we are also doing having a trading account with us. So we'll doing the trading of particular stock, future, option, and all this. So I taken the example like future. So in option get expired every month because his have the expired, but future also get expired, but we can roll over that future. So you heard about in the Nifty we are holding or particular stock future we are holding. So what we'll do, we'll sell the future of that stock at expiry date or for means the contract value expiry, and then we'll buy the again the new contract for the same again. So it is a future in particular stock market we do the future rollover. So same example we have taken, and before we have taken the example of a home loan, that in the first slide first only. So now moving to the some two market like LSTA market and LMA market. So how it is important and how rollover play important role in this market. So as per the scenario basis we'll go one by one. Scenario: a US corporate borrower rollover 500 million rolloving credit facility nearing to maturity. So so we are taking the example like in 500 USD, because LSTA market always trade in the USD and LMA market trade on the euro. So we are taken the 500 and 400 million example. Rollover process: negotiate extension with the existing lender, amending maturity of 3 additional year. So if rollover will be done, so will be many negotiation between the lender extending the maturity, because if old loan get expire in one year, so the borrower will ask to extend 2 year more regarding the rollover. The same for the LMA market. Here here in LSTA market they want to check with the lender, but in the LMA market collaborate with the lead arranger to refinance the maturity loan and new syndicate facility. So both market will have the same concept, but whom to reach is depend on that market. Here the lender, here the lead arranger. The interest benchmark. So transaction from LIBOR to SOFR, floating rate calculation. Here also transfer to the UBR to SOFR. So SOFR is a new standard rate where the where the trading has been happen, and accordingly the fixed standard rate has been decided. So shortly we'll prepare the separate video on this. We are working on this. Key documentation. So the key documentation is amended restated credit agreement based on the. So already there is some agreement has been prepared when the old loan take, but if new loan additional, so they have to prepare new agreement. So that LSTA market is talking about. The same for the LMA market as well. So LMA market compliant facility agreement with updated terms and conditions. Same here. Our outcome: loan maturity outcome, lender earn extensive fee for agreeing new term. So here what I am talking before about this, what borrower is losing is fee. So lender will not give directly additional amount of a loan and combining with the old loan and all this. So he also get a benefit. So lender will charge extensive fees regarding this rollover. Okay. So borrower long term financing gain fresh syndicate opportunity. So both LMA market and LST market charge accordingly. So US market often actively trading secondary market, European market emphasis detailed structuring on the one frequent. So there is some change according to market, but the term is same. The key difference between LST and roll market. So regulation. So here the regulation again can focus on SOFR post LIBOR. So before there was a LIBOR on this interest rate fixed interest rate or standard interest rate, where in India we are using the repo rate and reverse repo rate when we taking the home loan, or when we taking the personal loan or any loan, it will depend. So same for loan syndication, rollover and all this process, SOFR is a standard rate, should be taken in consideration. So documentation, LSTA, credit agreement format, there is some format is there, accordingly they have to form. Same for LMA, follow the LMA template for uniformity. The market characteristic, US loan often traded more actively, European loan emphasis structure term. So in a US market is more traded actively, but in LMA market European emphasis on structure term, there is some structure term, accordingly they will work. So the more important part is this only, the example, how we can verify this rollover, and how we get a, like if we do the normal reconciliation of a hedge fund or private equity, or maybe the normal what we can say the alternative investment solution, and this. So usually we get a corporate action break, we take example of dividend. So how you validate your corporate action with the BBG, correct? So same here, if some rollover break in came in your recon, so how you validate? So you validate with the proper thing. So in loan syndication, we have many platforms. So like if you check your daily emails, if you are working professional, so you get a daily contract note with the client, or maybe broker, or maybe instruction from the client, broker release contract note, or maybe something there. But at our reconciliation side, we are using the pricing letter. So pricing letter is nothing, it is a just a notice of what action has been taken for this rollover, on what basis this rollover action has been taken. Like they will mention the basic thing, like how much amount of a loan, a new loan has been disbursed, who is the counterparty like borrower and lender, what is the interest rate, what is the maturity. The same concept will be there, like if you have taken any loan, so same concept will be there, but the parties will be different, the rate will be different. So same here we'll discuss now. Example, the borrower is XYZ Pharmaceutical Private Limited. The purpose is the borrower is a pharmaceutical company. Purpose is to extend the maturity for existing transaction under the underlying loan facility 50 million rolling under the LSTA market. Okay, so this is an example of LSTA market, means US market, and he want to increase maturity date. Okay, so key detail for pricing letter, so extending transfer amount for 10 million. So this he want, borrower want 10 million more. So the existing tranches amount is 10 million. The original maturity is 10 October 2024. Rollover period 90 days, and maturity will be 8 January 2024. Interest rate will be there. So interest rate will be calculated SOFR rate plus interest rate, and then same interest rate they have to give. Fees will be 0.25. So basic detail has been given. So now moving to the rollover notice, like pricing template. So here the notice has been released, because if borrower and lender has agreed on the part, so same one letter has been designed, the pricing letter, or we can say the notice, and this same notice has been released on the particular we can say the verified site, we can say the S&P market, where we can see entering the investment name, we get this type of notice. So we have draft, this is a manually draft, we have draft, and same notice will be available there. So the date will be the 5th October 2024. The administration agent is ABC. So agent is here ABC from pharmaceutical company, pharmaceutical release. Rollover notice 10 million under the rollover facility, whatever the agent name and whatever the subject line is there. The same detail has been mentioned, and we confirm that this roller aligned with the term of a loan agreement. Means they are mentioning that when they have done the original contract, so in this the many terms are there, so they are using that term to roll over this all the thing. So same they have mentioned in original term, they have mentioned, and they have their signature and all this, and accordingly this pricing letter will be there. So when we get a break in our rear reconciliation when we are doing, so we have to validate this all the things like amount, maturity date, rate, fees, borrower, lender, and how many it enter into system correctly or not. Sometime in system the date of a maturity or the start date will be wrong. Sometime the rate of a SOFR is rate, so we have to check online what are the SOFR rate on that day when the contract had been signed, and adding the fixed rate. The fixed rate is 3% only, and SOFR rate will be depend on this. So SOFR rate will be when they are doing the agreement, so it will be depend on the flexible as well as the fixed. If fixed is there, so fixed is mentioned in the loan agreement pricing letter. If variable, so we have to calculate it on the daily basis, and systems our accounting system should be there. One option is there automatic, so automatic system will get calculated. So there is some options are available according to contract note. We have to according to the pricing letter, according to notice, we have to change. So benefit is same here, flexibility, extend the liquidity without requiring new application. So there is no new application has borrower has to do. He can take a new loan on the existing loan with the same lender, and the some terms and conditions will be changed, and the both loan can get merged. Cost efficiency as well, retain cost efficiency means the legal or maybe the market rate or maybe the existing terms will be not, so he is the cost efficient, his time also gets saved. Operation continuity, ensure the interrupt with the cash flow, and this sometime borrower need very urgent, because sometime he is in manufacturing business and he get a lot of order, and he is manufacturing car for example, and he got a order of 1000 car, and he required money in next 15 days. So it is important on the operation basis also. If his operation will stop, so whatever money he's taking additionally, it get disadvantage. So this rollover facility get a benefit to the borrower as well as the lender as well. So we have explained the whole the terms with the real life example, with a corporate example, with the loans indications. If you have any doubt on this part, because we have taken much time on this part to explain you, but it is very important, that's why we have taken the time. So thank you so much for watching this. If you have any doubt on this part, on any particular topic that in previous video as well, you can directly comment us, or you can reach directly to us. We have our contact number with in your description. You can reach out to us personally as well. Thank you so much for watching.